Hello, everyone, and welcome to another episode of Selling Greenville, your favorite real estate podcast here in Greenville, South Carolina. I'm your host, as always, Stan McCune, realtor here in Greenville, South Carolina, although I'm recording once again from a cabin in Georgia. Same day, recording this the exact same day as the last one that I recorded. Sometimes I do this, I'll record multiple pods in the same day. So anyway, in case you hear the noise difference, the audio difference, or see if you're on YouTube that I'm in a cabin or on a back porch, that's why. But you can find all of my contact information in the show notes if you need a realtor in the Greenville area. And just a reminder, as always, please subscribe to the show that you don't miss future episodes in whatever podcast app you're using or on YouTube. Subscribe to my channel on there. Just search for my name, Stan, S-T-A-N, McCune, M-C-C-U-N-E. Like, review, rate, subscribe, do all of those great things for this show, and I would really appreciate that from you guys. Today we're going to be talking about mortgage rates. Of course, we can't get past mortgage rates. One thing that I've learned in the 3 years that I've been doing this show is that there is always just something that is kind of captivating in real estate, something that just kind of controls the real estate narrative. And right now, it's mortgage rates. Like, that is the talking point. That is the thing that people are most concerned about. And so I'm going to give the people what they want to hear. And that is a discussion on mortgage rates. Now, I ask for a little bit of patience because I've got a lot going on here on one single screen. I don't have multiple screens here, but I have multiple different things that I'm doing on my one single screen. And so if you're watching on YouTube, you're going to see that I'm going to be screen sharing the 30-year fixed rate mortgage chart from the St. Louis Fed. And so I want you guys to look at that. It's helpful to look at it, but I'm going to explain all of this data as well for those that are just listening in. But yeah, I've got notes. I've got this chart. I'm going to try to keep you guys on the video following along with the chart. But understand too that there are some things, because I don't have this chart fully expanded. Not all of I won't be able to get down to the exact numbers on everything. So just understand that if you're watching. But here it is. We have, again, if you're looking on YouTube, I've got the entire 30-year fixed rate mortgage chart, courtesy of the St. Louis Fed. And one thing I just want to point out, I feel like this chart and the numbers that they have on here are slightly low in comparison to what reality is. I don't know why that is, but all of these averages on here appear to be a little bit lower than what they are or have been in reality. So that's just something to keep in mind. But what I wanted to look at here in an exercise that I did in order to help you guys, in order to kind of give me an idea of what's going on and what might happen in the future, was to see, I've got something that just went into my mouth. Again, here I am outside on a porch, so there are bugs and whatnot flying around. I wanted to look at historically what have happened with 30-year mortgage rates, because they do fluctuate, right? There are times when they're high, sometimes when they're low. Of course, that's all relative, but they go up and down. And so I wanted to see historically, when rates have started to go up, how long do they typically stay up, right? Because that's the story of real estate right now. How long are the rates going to stay where they are? As I'm recording this, we actually just had them shoot up recently. I'm recording this the end of June. This probably won't release until mid-July. But we've had rates shoot up just recently here at the end of June. And here they are at or above 7% for most people. And again, this is the 30-year fixed rate mortgage. There are other products out there. There are variable rate mortgages and things of that nature. More people are looking into those, but most people just like the security of that 30-year fixed rate mortgage. And so, historically speaking, looking at the data, how frequently do rates stay at an elevated level in comparison to what they were when they have a dramatic shoot up? So what I did was Well, actually, before I get into my methodology, I do want to say this one thing, okay? I have to say this. And if you're looking at the chart, this is very apparent. But if you're looking back 50, 60 years, mortgage rates still are not that high in comparison to that data sample. If you go back into the 80s, rates were really, really high in the, on the St. Louis Fed information that they have here, into the high 18s. I've seen other data that indicated it was into the high 19s or the 20%. That's much, much higher than the 7% rates that we're looking at as I'm recording this. And there was a very lengthy stretch during the 80s when it was at least above 15%. And then even when it came down from there, it was typically above 8%. So being in the 7% range, historically speaking, going back way, way, way back, is not that high. But going back 20 years, which really is a more fair way of doing this exercise, right? Because the majority of homeowners are people that have purchased their home the past 20 years, right? Rates are actually pretty high right now in comparison if you go back 20 years ago. If we basically we have to go back to like the 2002 year before we really start to see rates in that 7% range again, and they had come close. If we look around the Great Recession right before in 2006, 2007, they kind of came close to the 7% range, but they didn't hit it. And so here we are with rates that are the highest that they've been in really 20 years. And that in the real estate world is a very, very long time. Now, looking at this chart was an interesting exercise. What I did was I looked at the years where there were big jumps in mortgage rates, at least a 1% jump in less than 12 months. And then I looked at how long it was until rates returned back to what they were before the jump. So that was really essentially the two things that I did. But I only went back to 1987. I'm kind of jumping ahead of myself. So let me just go back for 1 second. If you look at the entire chart that the Federal Reserve has provided, you can see that essentially since 1984, rates have been steadily going down until just recently when they started this dramatic uptick that started in the middle of 2021. And a lot of us, myself, a lot of other experts, if you want to consider me an expert, if you want to lump me in with them, we've been saying when rates were insanely low in 2020 and 2021, that they were going to go up, that there was no way that they could stay there forever, and that they probably would never go back to those levels. What we did not foresee in 2021 was rates doubling, going from 3% to 6% and now 7% in a very, very short period of time. And there was an assumption for a while this year that that rates would actually go down before the end of this year. At the beginning of the year, many were predicting rate cuts before the end of the year. But listen, that sentiment has all but dissolved. And there's a lot of reasons for that. But now some people are starting to say, perhaps we should be bracing for rates to stay in the 6 to 7% range, mortgage rates, 30-year fixed rates, in the 6 to 7% range for maybe the next several years. And I've long said, if you've listened to this show for a while, I've said that I think the Fed really likes to tinker with rates. And the moment that the economy starts showing signs of weakness, they are likely to start cutting rates. But that is more of a hunch than anything. There's really no data behind that. And when banks started going into crisis a few months ago, we had Swiss Bank ran into problems, had to basically be bought out. When all of these things started happening, the Fed didn't blink. The Fed didn't be like, oh, we gotta calm down on the rates. No, they didn't blink. They kept hiking rates even as banks were failing. So I do think it's worth looking at the historical data to see what has happened traditionally. And but we also need to consider that the current Fed operates obviously much differently than it did 20 or even 10 years ago. There's a lot of turnover in the Federal Reserve. We talked about this a few weeks ago. And so we need to look at the historical data, but also realize that history doesn't necessarily repeat itself, and really in reality history never repeats itself, but it does often rhyme. History does frequently rhyme, and so I would not be surprised if we see some similarities coming up here to what we have seen in the past. The question is, as we'll get into this, is it going to be the past from 30 years ago or the more recent past? Now, because the early 80s were like extremely volatile, mortgage rates in the early 80s were just insane. And if you look at a chart, you'll see that. I didn't feel like it was fair to include that data in here. That just would have really confounded everything. So I really want to start in 1987. I feel like that is the best period of time to start in. Get past the major recessions of the early 80s and start in 87. If you're looking at the chart I've got, and you're not familiar with this chart, the grayed out areas, those are recessions that happened, at least according to how the Fed tracks them. All right, so let's look back at 1987, specifically March of 1987. In March of 1987, we saw rates that had been hovering for around the 10% mark for a while until the recession. They had been hovering well over 10% for a while. They finally reached a low of 9% in March of 1987. This is the lowest in a long time. But after that happened, they shot right back up. Okay, pretty much right away, and basically by May of that same year, they were in the tens. They went from 9.03% to 10.7% in just a few months, from March to May. So a massive, massive increase in just a few months. So this is the first, since all of that volatility, this is the first major increase that we saw. And then they continued to go up all the way through October of 1987 when they hit 11.5%. So a massive increase in 1987 that occurred. I was 1 year old when all of that went down, so I don't remember any of this. But it seems like interesting times for sure. So how long did these rates stay elevated? How long was it until they went back down to those March 1987 levels? Well, it took 4.5 years. We don't see it go back down until 1991. Once we hit, let's see here, it wasn't until September of 1991 that we finally see rates go back down to that level that they were in March of 1987. That is 4.5 years. That is an eternity in real estate, an absolute eternity in real estate. I can barely remember closings that I had 4.5 years ago. That was pre-pandemic. That was like almost a year and a half before the pandemic. I've moved twice since then. I mean, 4.5 years is a real estate eternity. So rates stayed above and stayed elevated for basically 4 years, and they didn't drop back down to that level where they were at for an entire 4.5 years. That's crazy. But rates continued to fall. Once they started falling, they continued to fall, and that trend continued until, let's see here, October of 1993, they bottomed out at 6.7%. And if you're looking on here, this is part of what I was saying, that I can't get it to show below 6.8%, but just trust me, they went down to 6.74%. And then after they bottomed out, then they shot right back up. And by October of 1994, they had gone all the way back up to 9.3%. So let's find that. October of 1994, they're right back up 9.03%. Now, this increase that we're seeing here, that's not as extreme of an increase as we've seen recently, but that's still a massive, massive jump. And that continued on throughout 1994, going into the low nines. And so, and staying in that low nines level up to 9.25%. It may have gone slightly higher than that, but I'm seeing at least it went up to 9.25%. So in a very short period of time, in just over a year, it went from 6.74 to 9.25%. So what happened after that? So after rates topped out at that 9.25% number in December of 1994, they didn't actually stay there. So they immediately dropped, and then they kind of bounced around. So they dropped into the low sevens in early 1996, before climbing back again. Then they had another jump in the summer, in June of that year, up into the low eights. Eventually, I have in my notes that they got up to 8.39% in June of that year. And then rates finally fell back to below 7% in June of 1998. So we finally go back down to the level where it was in June of 1998. Now, for those trying to keep track at home, all right, that's close to 5 years since they had hit 6.74% in October of 1993. Again, an eternity in real estate time. So from the time they bottomed in June of let's see here, what year did I say that was? Of October of 1993, they didn't go back down to that 6.74% for nearly 5 years. And that's insane to think about. And there was tons of, the other thing that's insane is how much volatility there was. I mean, rates going up, rates going down. Again, a period really marked by volatility. And I would not be surprised if we start to see kind of similar volatility like that happening again, coming back after we've had relative stability for more or less for the past 10 to 15 years. But then, again, rates got into kind of the mid sixes, and then they started going back up again. And so we have rates going, if we go to June of 1998, let's see here. At one point, they were in, it even goes, at some point, in June of 1998, they kind of got down to 6.6%. And then in October of 1998, basically 6.5%. And then they shot right back up in June of 1999. Going to find this on here. June 1999. They're already back up to 7.65%. And that just continued until it topped out in year 2000 at 8.54%. So another very big and very long period of time. But I will mention that's not as long as what we've been talking about. So they were elevated for this period of time for about 1.5 years. But it was an extreme increase during that period of time. But then after that period of time, once we start getting into June of 2000, rates are starting to go back down. And this is right before the dot-com bubble burst. That if you're looking on YouTube, you can see the recession in 2001. That's the dot-com bubble burst. And that caused, all of this caused rates to go down. And we don't see a percent point increase again in mortgage rates, at least the rules that I'm talking about, a percent point in a year or less. We don't see that happen again until 2003. So 2003, rates bottomed out around 5.2% in June of that year in 2003, and then they shot up into the mid sixes by August of that year, and basically bounced around between the high fives and mid sixes until the Great Recession. So they stayed elevated in those levels from 2003 until the Great Recession in basically 2008. Or what, you might not like the term Great Recession. Some people call it the World Financial Crisis. That's another way of people refer to that. So rates finally in December of 2008 finally went back into return to the low fives. And again, for those keeping track, that is over 5 years since they had hit that number in June 2003. And once again, it's triggered by a recession. Now, we don't see another rate jump like we've been looking for in a year until rates bottomed out again. So they keep going way down after the recession because, the Fed was really trying to control that recession as much as they possibly could. And so we don't see much by way of rate hikes until, hold on, give me 1 second here. Let's see here. We have a bottomed out, I have in my notes, April of 2013. Yeah. April of 2013, they hit into the mid threes, basically 3.4%. But then by August, it's already back up into the mid fours. So in just a few months, we saw that 1% increase from the mid threes into the mid fours. And then they mostly hover around 4% until September of 2017. And then we see things kind of start to go back down into the 3%, but then we see another big increase that ends up topping out in November of 2018, right around 5%. I remember, so by this point, I am a realtor. I've been a realtor for several years by that point in 2018, and I remember hearing people talking about, okay, this is going to really slow down the market with rates basically being in the fives. But then after that happened, rates started going down again. And then we had the pandemic. Rates went really, really low. And now they've been shooting right back up, as is the story of today. And so this is a lot of data for us to talk about. And I don't like to just leave you with the data and have you, just be kind of swimming in all of that. I want to make this practical, right? So what are some conclusions that we can draw from this data? I think a few things. First, I would be remiss if I didn't say that it's completely within the realm of possibility for us to continue to see these elevated mortgage rates, these rates bouncing between 6 and 7%. It would be completely within the realm of possibility to see them bounce around in that range for a while. Prior to more modern times, 4 to 5 years was the norm for these elevated mortgage rates. And so it would not be outside the realm of possibility for us to see rates kind of in this elevated state, perhaps another 4 years. I hate to say that, but that's very, very possible. However, if we're looking at the more recent years, that's really less the case, okay? In particular, it's noteworthy that until 2022, rate increases were much less dramatic, right? So we did have a few of these rate increases, these periods of rate increases that we talked about, but they generally were smaller jumps than what we had seen in some of these other, data, really between 1987 and the year 2000. After the recession of 2000 to 2002, or 2001, however you want to peg the dot-com bubble burst, those big jumps usually weren't that big. They were usually like 1 to 1.5% until this most recent one. So this is definitely what we're seeing is a modern day anomaly. It's also just a historical anomaly in general. But what does that mean in terms of the future? We don't know, because we haven't seen anything quite like this in recent years. We talked about rates bottoming out at 3.4% in April of 2013, But even when they went up, and again, this speaks to the stability of the past 10 to 15 years, even when they went up from that 3.4%, they mostly stayed in the fours. So it's not like they were elevated like way, way high like they are right now in comparison to what they were. They were elevated, but it was just kind of like a single percent point above where they had bottomed out at. I think another important conclusion is just obviously how impactful recessions are. Rates went down every single recession on record. Although you typically do, if you look at all of these, you typically do have some kind of a little bump that happens in rates immediately following the recession. That's pretty much consistent with all of these, with the exception of the pandemic, although it's kind of the pandemic was kind of a weird recession. But that bump is still lower than, generally speaking, than the pre-recession rates. And so recessions have a major impact on what happens in mortgage rates. The Fed tends to ease up on rates when a recession happens. So I think it's pretty safe to say if we hit another recession, rates will go down again. And so that's probably what it will take for us to break this cycle of seeing rates in the 6 to 7% range. And then the question is, how far will they fall? So if I had to guess at this point, I think the best case scenario from the standpoint of rates going down, I know that it's not positive for everyone for rates to go down, but let's just assume for the purposes of this show that it is a positive for everyone. I think we could potentially see rates go into the fours. I don't think the low fours, but maybe the mid to high fours is the most optimistic scenario. I'm not saying it's the most likely, the most optimistic. It's possible. Now, that may seem like a huge decrease from where they are in the sevens right now, but when you consider that the spread between the 10-year Treasury and the 30-year fixed rate is way higher than normal, you have to factor that in. And then once banks feel like inflation, like the inflation concerns are mostly past, I think that alone will cause rates to go down, even without the Fed doing anything, into the mid to high fives. And then if the Fed lowers rates even more, that's where we could see mortgage rates drop into the fours. How quickly will that happen? I mean, maybe 2025. Okay. Now I am hopeful that rates will come down in 2024, but for the possibility of them going back down into the fours, I think we're probably not until 2025. So I tend to think that we'll see rates as high as they are. Well, I don't think that we'll see rates as high as they currently are for the 4 to 5 year cycle that other rate cycles had, but I also don't see them dropping back down into the 2s and 3s anytime soon like they did during that short period of time right after the pandemic. It's possible we may never, ever see them drop into the 3s again. So as I've been saying on here for a while, the era that we are in is a bit of a new normal. We can't really compare this era to any previous era. I mean, let's just be honest. We experienced a period where rates had been going down very consistently since the 80s. And they couldn't just keep going down forever. And so now we're in this period where rates are the highest they've been in 20 years. And it's really hard to say what will happen, but I do think that they'll come down a little bit. And I think within 2 years in particular, that we'll be having a very different conversation. So we're looking at something not as extreme as some of these 5-year cycles that we saw in the past, but something much more extreme than what we've seen in the most recent past, where it's maybe 3 years of rates being close to double what they were at their lowest point. So I think the best case scenario is probably for rates to stay where they are roughly for the next 6 to 12 months, for a mild recession to happen, and then for rates to start to taper down once again after that. Just not likely to be at the lowest levels that they had been throughout much of the 2010s and 2020s. And I think that scenario I think that there's a very good chance that scenario plays out exactly as I just described it. I think that that's a very good possibility. And so we'll just have to be on the lookout for that. I think the Fed is going to hold the line. They're saying that they're going to probably do more rate increases. I'm not sure how much that's going to affect the 30-year fixed rate mortgage. It seems like economic volatility and bond markets, volatility in bond markets impact the rates at this point a little bit more than the Fed doing slight increases on their end. But we'll just have to see. But there's not, I don't think that we're going to see in 2023 any major relief from the high rates. I think in 2024, we will see a little bit of relief. And then I think probably by 2025, we'll see a lot more relief. But a lot can happen between now and 2025. So that's not a bold prediction. That is more of a gut feeling that I have. But we'll just have to see. But most importantly for now, it seems like for the next 6 to 12 months, everyone can kind of expect rates to be a bit elevated. And perhaps if we see a recession, we'll see rates come down a little bit at that point. All right. I appreciate you guys listening. If you have any questions, let me know. My contact information is in the show notes. Subscribe, like, rate, review, do all those things with the show. And we will talk again next time.